I guess you're looking at where you can actually take a trade and where you can actually put your stop loss, because liquidity is actually everything in the market. And this video is a full cap of what liquidity mean. Okay, so from this screen you can see that there are a series of candles. You can call it higher high, higher low, lower low, lower high, whatever candles you want to call it, internal higher high, internal lower low, or thereabout. But all these candles had the orders of money that took place in the market at different time frames. All right, the current time frame is on 4 hour. I trade with 4 hours. I refine with 1 hour time frame using liquidity. Okay, so most people cannot identify the liquidity in the market, and let me tell you that liquidity is actually the key. Is the key, is the number one strategy that every trader uses, because they're using it to cap the money in the market. You can't chase the trend. Okay, me coming to the market, I want to see what is the trend. Okay, the trend would determine if the trade you want to execute is going to be a buy, is going to be a sell trade. So in a chart like this, which is the UJ, you could see that from the beginning of the trend at this point, we have the lower low and lower high, lower low and lower high coming down to this point. All right, coming down to this point. The next question that you need to ask yourself is that at this point, what is the previous level that this place, at this point that the price came to touch? You would see that I'm literally giving you the golden tip of what liquidity means, and this is what I use to trade with. Okay, this particular point here, if I use like maybe an horizontal line to cap it, okay, very good. You can see that we have series of orders at this point, and this lower low, lower high came to sweep it at this point. That means it cancel out this particular orders. So there are a series of orders at this point, at this level for buys, but the particular touch that you see here is the sell. It sell further to pick out the stop losses that are at this point here. So there is always a gap that the price would need to fill at every point in time. There is always a gap that the price needs to fill. Okay. Now from this point here, you can see that it rises up before reversing again, and you can see it reversed, but it didn't get to this particular level. Okay, the liquidity stopped at this level. Again, let's use the horizontal line to drop where it actually stopped. Now, if you look at where it stopped, you see that this particular new level matches with the previous one that was ignored. And that is where the others came to tap from. Do you understand? So the chase of money, the orders of money, the push are all what makes the trade to be executed in the market. So you can see this as well going up, creating a reversal, coming down. You can see this is another liquidity sweeping. Now it moved to the upside again and came down. You can see it's another liquidity sweeping. Now use the horizontal line and place on it. You can see that it is still touching the series of points that were neglected in the previous time. Now it pushed to the upside. Now what you need to notice now is that it pushed to the upside. Smart traders are looking for a break of structure or something like that. Now it pushed to the upside. If you see this, you can see that it terminated at this point. Okay, creating a reversal to touch this liquidity that was existing and push to the upside. Now the upside that is pushing is creating higher high, higher low, thereabout. And this is to sweep this liquidity, because if you look at what happened in the previous time, this was not swept. It came to this point to sweep it up, and this wasn't swept, right? And this particular one came back, not up to it, but it came back to sweep it up and push to the upside again. Now, when you see this up to this level, just notice that we are going high again. We're just waiting for a break. This is the confirmation. Okay, this particular angle here is a confirmation to the upside. Now, from here, this is a break of structure. This is the higher low, higher high. It pushed to the higher to the upside now. You can see. Now, from this point here, you can see that, let me use another horizontal line to this level. You can see that we have series of gaps that is yet to be filled. We have series of gaps that is yet to be filled. Automatically, someone will be looking at, okay, maybe higher high, maybe looking at equal high, maybe sell from this place because this is high, so you get here, sell. It didn't work that way. It pushed further because there's a gap at this point. It pushed further to create more gaps up to this level. Let me use another horizontal line up to this level. Now, at this level, you see that we have series of gaps that were swept. Okay, series of gaps were swept at this level. Okay, so after that, you can see that the termination of this particular high to the downside created another gap at this point that needs to be filled. Now, if you look at it, remember that this particular holder was here waiting for a liquidity sweep, and this particular week is a confirmation of the sweep of this liquidity up to this level, if not everything, but at least up to this level, and push to the upside. This is the month of July. Now, it came down. Remember that the gap, there's still gap in front of this. We're waiting for what? The break of structure. This is 4-hour candle. This is what I used to trade with. We're waiting for the break of structure. Now, you can see there's still gap in this. The existing horizontal line that I drew from this point still exists, meaning there are a series of a lot of orders here, plenty orders here, but it won't go up immediately. First is to come down to sweep the low liquidity, creating an extreme supply or creating an extreme demand. If it's an upside, create an extreme supply. If it's at the downside, create an extreme demand. And from extreme demand, it pushes to the upside to create maybe the higher high, higher low, okay? Or maybe fair value gaps or something like that. So you can see from this point here, there was a gap, this gap as well. This gap is already filled by the higher high to this point. You can see there's still gap, it filled to the upside of this point. Now, there's still gap here. Let me use the horizontal line. There's still gap here yet to be filled. This particular area, still gap yet to be filled. Now, after this sweeping, it swept to the upside of this chart, right, before reversing to the downside. Now, all these are what? The fresh liquidity yet to be tapped. We're in a new month now, August. You can see we still have series of liquidity yet to be tapped. Okay, this is already fulfilled. We have series of orders here yet to be tapped. Now, up to this level, we have series of orders here yet to be tapped. There's another gap here yet to be tapped. That is how liquidity works. Now, what are you going to use to understand the liquidity and how can you catch the fish? Okay, because it's like you are looking for an opportunity for little orders, for your little orders to be filled, and you get them executed and you make profit, right? So now, according to the SMC, from this past or the previous candles, you can see from Friday, you will see that we have the fair value gap. You see that we have the fair value gap. Sorry about that. So you see that we have the fair value gap, which is this right here, from this point to this point. A very wide one. Trust me. The chart is coming there. It's coming there to fill it up. If not on Monday, Tuesday. If not Tuesday, Wednesday. If not Wednesday, it's coming there in the future to fill it up. Now we have series of, now the same horizontal line. We have one here, right? We have another one here. This is a strong base. This is a strong base, very strong base. You can see a touch here. We have another touch here. We have another touch here. So it's a strong base acting like support and resistance. It's a very strong base. Okay, so we're expecting the chart to fill up this liquidity, this one to the downside. Okay, after that, we're expecting a push. We're expecting a push into this zone, then reversal to tap this liquidity, then to continue the upside. That is how the market works. That is how the liquidity is captured in the market. And you may not expect the trade to come to the zone. You may expect the trade to come back a little bit, to do a little reversal, to sweep the stop loss, because the stop loss cap is actually what we are using. The stop loss is actually what the traders use, the big banks use to sweep all your money in the market. Okay, they trap all your stop loss, like stop loss hunting. They hunt your stop loss so that they can push further. All right. So this is 4-hour chart, and this is how I analyze my trade. And sometimes if I'm seeing the gaps too wide, I can go to 1 hour to see more confirmation. I don't go anything lower than that, because anything lower than that is just pure noise. Okay, so um so that's how it works. Okay, that's how it works in the market. This order is coming to be filled, and if you are doubting what is likely to happen, you can use the Fibonacci in that regard. You can use the Fibonacci. The Fibonacci is going to give you the measurement of, you can use the Fibonacci in the fair value gap. You can use the Fibonacci in the swing as well. Like this particular swing, I caught this trade on Friday. This particular swing, okay, I caught this trade on Friday. Okay, when I sold. Okay, I was expecting the sell to get to 50%, but okay, is it down? I was expecting the sell to get to 50%. I was expecting it to get to 50%, right? But my stop loss stopped at 50% when I took the Fibonacci from this swing to the last swing here. I was expecting it to get to 50% and stop there, but it didn't. Okay, so we're going to look at how we can use the Fibonacci in the next video to analyze possible trades for liquidity, because it works for liquidity, especially for expansion or especially for withdrawals. Okay, so it's very, very important for you to see that. All right, so most traders can tell you that, okay, maybe equal highs, equal low, maybe you have series of trades like this, you have something like this, then it touches this point and it is drop. It works because, as you can see, this particular area here, this is something like the equal low, equal high, something like that. The upside of it is like the stop loss hunt, but it's definitely the equal high. If you use this particular place, equal high. I traded this last 2 weeks, yeah, because this Wednesday 16. I used equal highs and I made about I think 200, like $200 or so. It's 0.05. Yeah, so something like that. So, and the opposite is the equal low liquidity. Okay, equal low liquidity like this, and it comes to this point, then it's reversed to the upside, because all these are liquidity that are meant to be filled. All these are liquidity that are meant to be filled, creating higher lows to the upside. Sweeping, reverse, sweep, reverse. When it sweep, it reverse. When it sweep, it reverse. That's how the trade works all the time. All right. So thank you so much. This is my strategy that I use to trade with all the time. Liquidity, looking for the gaps. Why wait for the breakout structure? Because the breakout structure confirms my trend for me, and that is what I use to specially take my trades.